The Imara African Resources Fund has delivered a compounded annual return over the past 3 years of 1.8%. This against the fund's benchmark, the MSCI World Commodity Producers Index, delivering a return of 11%. For more, Bruce Williamson from Imara Asset Management joining us in studio. Bruce, thanks very much for your time. I think let's address it right at the top, the underperformance compared to your benchmark. Obviously, policy, I've read a couple of notes relating to the fund, and policy is not working for you when it comes to the resources environment.
All right, well, I mean, what we do is I use that as a benchmark. It's more just sort of an indication. I don't strictly benchmark per se against it. Remember, in that portfolio of MSCI will be all the global big players, whereas where we look to invest is below those big global players.
Bruce, do you think there's more of an appropriate index that could be developed that you could measure yourself against? In other words, I'm not saying it's in place now, but do you think there's scope on the African continent to develop more benchmark indices? Well,
yeah, sure. As a lot more of these companies get bigger in terms of market cap, in terms of liquidity, then that can start happening. But you know, it's pretty irrelevant to benchmark yourself against something that is untradeable and illiquid.
Now let's talk about the geographies that you are exposed to. I see 36.6% squarely in a South Africa play. We'll drill down more into that a little later, but a relatively high Zimbabwe exposure at just over 17%. You're backing the Zimbabwe story, obviously.
Yeah, I mean, there's a little bit of history. We started this fund 1 January 2009. Initial funding that came in, these are dollar funds. My first port of call was to look at the South African market, a market that I've sort of followed for about 30 years. That's where I did all my portfolio buying. And then slowly, as I gained confidence, was to look beyond that. Zimbabwe, one of the stocks that has really done well in my portfolio and I held was Zimplats. And so that's ended up as being a key player. And then New Dawn, which is a Canadian listed gold player.
And going elsewhere in Africa, have you found it quite easy to diversify the portfolio within Africa? I'm talking about in terms of access to different counters, in terms of research and being able to understand companies quite easily. Is it getting better? Absolutely.
Just from a research point of view, probably the last 2 years, we've seen a lot more research coming out. Pretty exciting. Some very good stuff now coming out of the UK. Canada's always been there, and Australians have been pouring into Africa. And with that, we're starting to see research that supports the juniors coming in. In terms of stock selection, remember that a lot of African funds, you would typically buy stocks in African markets, and those are very illiquid. With the resources, most of the buying is done in the AIM market, Toronto, Australia, and here. Liquidity in Zimbabwe, Zambia, Botswana is not that great, but I've got very good access to decent liquidity in the main resource market.
So when you look at your fund in total, do you feel that you can offer it into the retail space? I don't know if you do offer it into the retail space in terms of having liquidity at hand that the retail investor might need.
Yeah, absolutely. I mean, there's, you know, we're a tiny fund and we've started out and people have said to us, listen, go away, get a track record that we can understand, that you understand. And we think now, after 3.5 years, that we're there. I mean, a fund from 100 to 200 to $300 million would be easy to manage because we're managing it in pretty liquid markets, and there's just more and more players to look at.
What is going to be the kicker for you from the resource story? Are you waiting for Chinese news flow to shoot the lights out and suddenly we'll see a re-rating of resource stocks across the board?
Yeah, I think, look, I mean, it's not only China. Remember that the developed economies, Europe, the UK and the USA, these are the guys that have let us down. It's not China. It's the developed market that is laden up with credit that's really doing the damage. We need those economies to find a way to stabilize and to start growing at 3-4%.
3-4% growth in the developed world. I mean, somebody would say that you are dreaming. Yeah. That we're going to see that anytime soon.
No, we're not. And therefore, I don't think we've quite seen the bottom of this resource market. I mean, shares have been pummeled, knocked back, and that's what happens. people sell to just take the money back. I mean, even the Europeans are taking money back home, and the USA take money back home. So it's not the bottom. We're going to need some producers to start cutting back on production to tighten.
Which is what we're starting to see in the platinum environment.
When you look at your portfolio currently, obviously resource shares have taken a bit of a knock. Do you then are you switching out of resource shares into cash? Are you holding a high element? Or do you see this as a buying opportunity? Given what you've just said, that you think resource shares are still going to take a knock. In other words, are you protecting against that knock with cash?
Kevin, our mandate is we're an equity long only fund. And typically what happens is customers who give you the money, they make a call on what cash they're going to sit on. So they expect the fund to be pretty much fully invested. So I've got 5% cash. I'm doing very little. We've got a small fund. Stocks have taken a hammering. I'm happy with the construction of the portfolio.
So let me just interrupt you. So then how do you construct the portfolio given that it's then almost fully exposed to the resource sector? How do you construct it to still be defensive within resources?
Well, I mean, that's why you'll see I've got about 35% in gold. And my single biggest holding has been Pan African Gold, our local player, which is, as a resource stock goes, has held up really well. That's as about defensive as I can get. We're not a hedge fund. I, in fact, would love to have a hedge fund, because as a resource guy, when you see things are too high or too low, you actually need to be able to hedge.
But now that's not going to sit well with you in terms of gold being the protection element in the fund. And I push Kevin on this one on a regular basis.
I'm still waiting for your guy to be right with $15,000.
He gets hate mail on a regular basis because of his gold views.
She brought somebody onto the show who said gold's going to $15,000 an ounce, and it's got a long way to go.
Okay, but what I've got going for me when I look at it from my angle, trying to offer some protection, is the dollar price I can look and think about, the rand I can look and think about, and so the combination of those two have given me a reasonable rand gold price. Then I look at the fundamentals. I mean, I've looked at SA golds for 30 years now. There's a whole heap of them I wouldn't dare touch, but Pan African, I've been very happy. Stable production from where they're at. They've got a platinum group metal project, recycling, very low cost. And then they're acquiring Evander, which I think is going to be good for them.
And you'll be glad to know it was $5,000 an ounce. That was the target price from the guest we brought onto the desk. It was the wow factor, $5,000 an ounce.
Okay, because that's imminently more achievable.
Only.
Only, exactly. Well, there we go. Let's get your forecast, Mr. Williamson, on gold.
Can I just ask you about policy environment? We've seen a lot of uncertainty in the South African market, all this discussion around nationalisation, then to do with taxes and mining taxes, etc. How big an impact does that have on a fund like yourself? In other words, I can understand it having an impact in the SA market. Does it affect the rest of Africa to any extent?
It's difficult to know what goes through the mind of global investors, but you know, we kind of get put in the same box. So if South Africa is thinking of doing this, Zimbabwe, the noises coming out of there haven't been good. It is a danger. We get put into that same box, except that you've got to get out there and just keep on talking to governments, mining companies, and then back to the investors. I mean, the news coming out of Botswana, their diversification, they're making another determined effort to move away from being diamond dependent. They're doing all the right things. Fantastic policy noises coming out of Botswana.
How do you...
That's it. You haven't got any more time.
Oh, okay.
Is it a quick one? A very quick one?
Very quick. How would you advise somebody to play this type of fund within a portfolio? Is it a bolt-on, or do you think this could be a core holding?
Well, I think, you know, resources clearly have been more volatile than most of the other sectors. So it's a time and a place. You know, we can provide that kicker when you look in discussion. We'd agree that, hey guys, this is a real bottom, and there's a time coming now where you can get into resources.